Good evening, students. Happy New Year. Welcome to this session. Good evening, Shankara. Happy New Year. So, have you revised what we discussed in the last class? Because that was something which was something very new for you. Have you revised, students? You got good number of days to do the revision. I hope you have revised that. So, today we are going to start with the assessment procedure. Yes, good evening, Sailesh. Good evening, Viraj. Happy New Year. Good evening, Mohammed. All of you have revised or not? Any questions if you have regarding that topic, you can ask me now. Otherwise, we can just proceed to start with assessment procedure topic. Just write down the heading, assessment procedure. Okay. So first in the assessment procedure, yes, good evening, Mansha. Good evening, Tariq. Happy New Year, Mansha. So in the assessment procedure, how we are going to divide this particular topic is something which we'll discuss first, okay? Because there are multiple things that we have to discuss over here. Number one is, first we will be talking about the return of income requirements. Who is required to file the return of income and what are the due dates regarding the same? PAN number, Aadhar number, SFTs, all of that we will talk about first. Secondly, we will be talking about the assessment procedure, how the assessment procedure starts. So that is what we will be discussing. And then in that, we will have the faceless assessment. We will have the rectification at the end of that. So all of that, and we will also be again discussing about the income tax authorities, powers which are there. So these are the topics that we are going to cover in this assessment procedure class. Okay. Yes or no? Any questions if you have, you can still ask me regarding the previous topic. Otherwise, we are proceeding further. So first is return of income. Just write down. All of you would have done so many ITRs during your articleship, isn't it? But have you checked ever who is required to file the return of income? First of all, whether you are required or not to file the return of income. That is the first question. So yes, students, tell me who is required to file the return of income. Is it compulsory to file the return of income for everyone? Yes. For the individuals, for the individual, the return of income is required only when the total income exceeds the basic exemption limit. Now here total income does not mean the net total income. Here the total income without giving effect to the exemptions under the 54 series, which is for the capital gain, and deductions under chapter 6A. So total income means your total income, which is the net total income, but without giving effect to before the deductions under 54 and the deductions under chapter 6A. Now, what is the logic of that? See, what can happen is I can have total income less than the basic exemption limit. If I do not consider these exemptions or the chapter 6A deduction, and I say that my total income after these exemptions or deductions is less than rupees 2.5 lakh, which is the basic exemption limit, or rupees 3 lakh if you go for the new regime, then I will not file the return of income. But how the assessing officer will verify that the exemptions that you have claimed are correct or not? How the assessing officer will verify? He would not be able to verify that. So therefore, here the provision says that in case of individual, HUF, AOP or BOI or the artificial juridical person, if my total income without giving effect to exemption under 54 series or chapter 6A deductions. Or chapter 6A deductions exceeds the basic exemption limit. So in that case, I am required to file the return of income. Meaning it is not compulsory to file the return of income. It is not at all compulsory. Are you getting that? So filing the return of income is not compulsory for the individuals HUF, AOP, BOI. Are we clear about that point? So only when my income exceeds the basic exemption limit, the total income means what? The total income without giving effect to these particular section 54 series exemption and the chapter 6A deductions. Are we clear? So that is for individual. Secondly, in the case of individual, let me make a chart for you so that it's easier for you to understand. You can write like this: requirement to file return of income. First, I am talking about the individual HUF, AOP and BOI. Okay. Right. Secondly, in case of individuals, again in case of individuals, if the individual is a beneficial owner of an asset and is a resident ROR, not RNOR. So this is only for individual I'm saying and not for HUF, AOP or BOI. Sorry. And individual, okay, who is ROR. An individual who is ROR, if he holds beneficial interest, if he holds a beneficial interest in any asset, or if he holds, if he is a beneficial owner, otherwise you can write like that, if he is beneficial owner or is beneficiary of any asset including the financial interest in any entity, including the financial interest in the entity located outside India or has a signing authority in an account located outside India. Now, what do we mean by the term beneficial owner? So let's say, for example, if an individual is not required to file the return of income because his total income is let's say less than the basic exemption limit. Let's say my total income is less than the basic exemption limit. Let's say it's just rupees 1 lakh, or let's say rupees 2 lakh. Now in that situation, the question will arise is that whether he is required to file the income tax return if he has any beneficial interest, or if he is a beneficial owner or is a beneficiary of an asset located outside India. And the answer to that will be yes. So even if his total income would be less than the basic exemption limit, but if he is a beneficial owner or is a beneficiary of any asset located outside India, he would be required to file the return of income. Now the question arises, who is the beneficial owner? So section 139, explanation to that, defines the term beneficial owner as any individual who has provided the consideration for the asset for either the immediate or future benefit of himself or any other person. So a beneficial owner is somebody who is funding that asset. It could be for the asset could be used for the benefit of himself or for some other person. But he has purchased some asset by spending the money on that. And that asset is located outside India. Now the asset also includes any financial interest in any entity. So let's say, for example, if the individual has not purchased any asset, but he is a partner in a foreign partnership firm or in a foreign company, he would be mandatorily required to file ITR without his total income exceeding the basic exemption limit. Or let's say, for example, I'm not even a partner, I do not hold any stake in any company. I'm not a shareholder in any foreign company. I just have a signing authority. I have a bank account outside India. So even if I just hold a bank account outside India, even if my total income does not exceed rupees 2.5 lakh or 3 lakh, as the case may be, I would be still required to file the income tax return. Are you getting that point? Or I'm not a beneficial owner. I'm a beneficiary of that asset. So if the beneficial owner is there, but I'm a beneficiary of that asset, who is deriving the benefit from the asset. So I'm not contributing towards that asset, but I'm deriving the benefit from that asset. Then also I'll be required to file the return of income. But if, let's say, for example, my beneficial owner has filed the return, I will not be required to do that. So if the beneficial owner doesn't file, beneficiary has to file. Are we getting this point? So an individual has to file the return of income where his total income exceeds the basic exemption limit. Number 1 point. Total income means without considering the section 54 exemptions and chapter 60 deductions. Shankara, your question is that if, let's say, for example, the GTI is below 5 lakh, you would get rebate under 87A and you're not paying any taxes. You're right. But then also you're required to file the return of income, though you're not required to pay any tax. The answer is yes. You are required to. Because what is your basic exemption limit? Your basic exemption limit is, Shankara, 3 lakh rupees in case you go for the default tax regime, the new regime which is there. And where you're opting out of the default tax regime, your basic exemption limit is 2.5 lakh. For the normal individuals, for the senior citizens, it is 3 lakh. For the super senior citizens, it is 5 lakh. So, in that case, if you are not a senior citizen, your basic exemption limit is 2.5 lakh only. Then, even though you're not paying taxes, but you're required to file the return of income, Shankara. Are you getting that particular point? So if my total income exceeds the basic exemption limit, I am required to file the return of income. Secondly, a resident and ordinary resident, a ROR, an individual who is ROR. This is not for non-resident. This is also not for resident and not ordinary resident. This is only for ROR, who is a beneficial owner or is beneficiary of any asset, including the financial interest in entity, or has signing authority in any bank account located outside India. Signing authority, Namrata, means that I have the bank account where I am required to, I am having that signing authority. Let's say, for example, it may not be bank account of mine. It may be bank account of some partnership that is there. Or it may be bank account of some other person. But I have the signing authority. So that is the meaning of signing authority outside India. Are we getting that? So then in that case, the individual is required to file the return of income. Third one. This is for any person who is not required to furnish the return of income. Let's say he doesn't have the total income, or this AOP or BOI does not have the total income more than the basic exemption limit. But if they have deposited rupees 1 crore greater than equal to rupees 1 CR, not equal to, sorry, greater than rupees 1 CR in the current account. In the current account. So deposit of rupees more than rupees 1 CR, this is for not only individual, but individual, HUF, AOP, BOI, artificial juridical person, everybody. So they have deposited rupees 1 CR greater than rupees 1 CR in the current account. Incurred electricity expense of more than 1 lakh. Okay. So if I have the electricity expense more than rupees 1 lakh, I will be required to file the return of income, even though my total income may be lesser than basic exemption limit. Why these are the particular provisions which are mandated for the persons to file the return of income, even if they have the total income lesser than basic exemption limit? Because the department wants to verify that if they have done such a high value transaction, how come they have the total income lesser than the basic exemption limit? See, if you have the money, you are depositing the amount of rupees 1 CR, then how come you don't have the income greater than the basic exemption limit? And that's why the department has mandated these categories to file the return of income. Incurred foreign travel expense greater than rupees 2 lakh. This will be for the individual, because of course the HUF, AOP, BOI, artificial juridical person cannot travel. Then total sales, turnover, or the gross receipts exceed rupees 60 lakh. Total gross receipts, this is 60 lakh of the business. This is for the business. And for the profession, total gross receipts greater than rupees 10 lakh. This is for the profession. So for business, 60 lakh, for the profession, rupees 10 lakh. Aggregate of TDS and TCS, aggregate of the TDS and TCS is greater than rupees 25,000, greater than equal to rupees 25,000 in case of senior citizen, which is resident individual greater than equal to 60 years, this limit shall be 50,000. Limit shall be greater than equal to rupees 50,000. Are we getting that? Yes or no, students? So in these cases, they are required to mandatorily file the return of income. Shankara, good question, that if a person has filed ITR for 1 year, should he file the ITRs for all the upcoming years, or is it allowed to file for 1 year and not file for another year? See, you have to decide each year. Let's say, for example, Shankara, this year I am earning, let's say, 10 lakh rupees. And suddenly something happens, I may not be able to earn in the next year. Let's say my business is discontinued, there is some disruption which has happened, and because of which I am unable to earn anything. So I don't have any mandates that I have to file the return of income in this year as well, just because I have filed the ITR for last year. You have to check each year these conditions for the individual HUF, AOP, BOI or the AJP. Every year you need to check whether my total income without giving effect to Section 54 series and Chapter 6A deductions exceeds the basic exemption limit. If the answer is yes, only then you are required to file the return of income. Otherwise, you check the two other conditions. If I am a beneficial owner or a beneficiary of any foreign asset or foreign bank account that I have, or let's say, for example, I may have the financial interest in any foreign entity, or I have incurred these kind of expenditure where I have the electricity expense of more than rupees 1 lakh, foreign travel expense of more than rupees 2 lakh. I have deposited rupees more than 1 CR in the current account. What are my total sales, turnover or gross receipts? Whether it is exceeding 60 lakh for business or 10 lakh for profession. Whether the aggregate of TDS and TCS is more than 25,000 for senior citizen, more than 50,000. You need to check that. Every year this has to be checked. Just because I have filed the return of income in the last year doesn't mean that in the coming years also I have to file the return of income. Clear, Shankara? Namrata, 1 crore is not only in one transaction, it can be aggregate. All of these limits that I have given to you, these are one transaction or in aggregate. If it has exceeded these amounts, exceeded these limits, then you are required to file the return of income. Yes or no? Any questions? Okay. So these are the requirements for the individual or HUF. For the firm and for the company, it is mandatory to file the return of income. They don't have any additional requirements. For the firm or the company, mandatory. Even if they do not have any income, they are required to file the return of income. For them, it is mandatory to file the return of income. Are we clear? Now coming to the due dates. What are my due dates to file the return of income? So all this while, we have been studying due date as referred to in section 139(1). For different provisions, you refer to this, right? If you do not pay this amount, if you do not claim this deduction, if you do not file this form before the due date of 139(1), you will not be required, you will not be allowed to claim that particular exemption, deduction or any other provision benefit which is there, right? So what are the due dates under 139(1)? This is given under section 139(1), the requirement to file the return of income, right? So what are the due dates? Yes, students, you know more than me. What are the due dates? Is there any limit to deposit in saving bank account, Tariq? No. This is for the current account that they have given, not for the saving account. Shankara, yes. The due date for giving the response under the e-campaign of IT department was yesterday, 31st December. So many associates had received this e-campaign notices from the income tax department during this Christmas, and the last date was 31st December. Yes, 31st July, 31st October, yes. You're correct, Shailesh. Yes. So there are different due dates. So first of all, where let's say for example, the assessee is a company. The assessee is a company. The due date is 31st October. So I'll separate this so that I can write the due date separately. The due date is 31st October for a company. The due date of filing the return of income for the company is 31st October. Now, a person whose accounts are required to be audited, whose tax audit is required, or audit under any other law is required. So even if I may not be required to do the tax audit under 44AB, but I may be required to audit, let's say under RERA, or let's say under the Companies Act, or let's say under the LLP Act, I may be required to audit. So then also my due date is going to be 31st October. For a company, the due date is always going to be 31st October. Any person whose tax audit is required or audit under any other law is required, then also the due date is going to be 31st October. Partner of firm whose accounts are audited. Whose accounts are audited. Either under the Income Tax Act or under any other law, for example, under the LLP Act. For them also, the due date is 31st October. For them also, the due date is 31st October. Fine. In case of an assessee, any assessee, it can be company, it can be individual, partners, partnership firm, anybody. If the assessee is required to furnish the transfer pricing audit report, then the due date becomes 30th of November for filing the return of income. So, any assessee including partners of firm who is required to furnish TP audit report. This will become 30th of November. And finally, any other assessee, it will be 31st July. Yes or no? Namrata, your question is if the total income does not exceed the basic exemption limit, but he has the TDS balance in his account, then he needs to file the ITR, or is there any other way to refund the tax? No, there is no other way, Namrata, to get the refund of tax unless you file your income tax return. So in case you have the TDS balance in your account, TDS credit reflecting in your account, then file the ITR and claim the refund. There is no other way to claim the refund. Namrata, e-campaign is an kind of initiative started by the income tax department, where we will learn about that shortly in like next half an hour, 1 hour. We are going to talk about that, where I'll explain you in detail how this e-campaign works. So just hold on for some time. I'll talk about that definitely. Um, yes, Mansha, yes, Namrata, you were correct. 31st October. For Mansha, partnership firm LLP, you understood it's not 31st October straight away. For partnership firm LLP, if the audit is not required, then you are required to file your return of income by 31st July. So it's not a straight answer that it's always going to be 31st October. For partnership firm Mansha, for LLP, you are required to file the return of income by 31st October only if the tax audit is required or LLP audit is required. Otherwise, you have to file the return by 31st July if you do not have any tax audit or any other audit under the LLP Act. You are required to file the return by 31st July. Clear, Mansha? Shankara, will any penalty be levied for not giving a response under e-campaign? Is it compulsory to give response? Shankara, the penalty will not be levied, but this could lead to reopening of the assessment, Shankara. So it is possible that the cases will be reopened. Even though you may give the response, it is possible that the assessments will be reopened. 90% chances that the assessments are going to be reopened, whether you give the response or not. But once you give the response, you have the kind of mechanism to say that okay, I had responded, because if you do not submit any response, they have the advantage on their end that the assessee never responded. So only that you will be in a disadvantageous position. There will not be any penal consequences, Shankara. Good evening, Simranjeet. Happy New Year. Okay. Yes, students, any questions other than this for the due dates? Fine. Okay. Now, understand, these due dates are very, very, very important. Because if you determine wrong due date, like you said, Mansha, 31st October, let's say you file by 31st October even for the partnership firm, when they are not required to audit, when there is no requirement for them to audit, it's possible that they do not have a turnover more than 1 CR, 10 CR, they are not required to audit, they are not even required to get the audit done under the LLP Act. Under partnership law, there is no requirement of audit. Under the LLP Act, you have the requirement to do the audit only when your total turnover exceeds 40 lakh. Let's say I'm a small partnership firm, and then you think that for them the due date was 31st October. But in actual, the due date is 31st July. So what will be the consequences? What are the consequences for late filing of returns, students? Yes, you would have received so many returns if you are doing your articleship. So many people were, calling up since till like yesterday also. Ma'am, we have not filed the return of income. And especially, after this e-campaign notices being received to the taxpayers during this Christmas period, so many taxpayers are calling. We have received the e-campaign notice. We have not filed the return of income. What should we do? So last date yesterday was for the return filing also. So what are the consequences if you file the return of income late? Yes, Salish, penalty to be paid. Yes, it's correct. Simranjeet, very, very important. Yes, loss carry forward will not be allowed. Yes. Late fees, interest penalty. Namrata, yes, correct. Absolutely. Interest under 234 BC. Yes, Simranjeet, very correct. So there are multiple consequences if you do not file your return of income on time. So if you do not file your return of income on time, there is, first of all, losses will not be allowed to be carried forward. the losses will not be allowed to be carried forward. That is number one. Secondly, yes, Sailesh, you cannot revise the return. Namrata, will come to that. Can we file return after 31st December? Yes, you can do that. There is an updated return. We'll talk about that. So you cannot claim set off of losses. There are losses which you can still claim the set off, even if you file the late return. Anybody knows that? Yes. Income from house property. If there's a loss under the head income from house property, self-occupied property loss if you have, or if you have the loss on the rental property, your interest is more than your income. Even if you do not file your return of income on time, you can claim the set off of the loss. Unabsorbed depreciation, you can still claim the set off. Are you clear? Secondly, you will not be allowed certain deductions which are there. What are the deductions which will not be allowed? We have done that. We have done that, isn't it? Under Chapter 6A deduction, there was profit-linked deductions. Profit-linked deductions, right? So these profit-linked deductions, ATIA, ATIB, will not be allowed to you. 10AA now, you're mandatorily required to file the return of income within the due date of 139(1). For example, under the charitable trust, if you remember, I told you, if you accumulate the income and you are not utilizing it for the current year, you can still get the exemption. That will be still considered as application, the deemed application of income, provided you furnish the Form 10 and file the return of income by the due date. Otherwise, the deemed application for the accumulation of income will not be allowed. Isn't it? That was in the context of charitable trust. So, other than interest, penalties, fees that will be levied, there are penal consequences even in terms of the allowability of deductions and the losses. So just write down over here. Just write down. Consequences of late furnishing of return. First of all, interest under section 234A. There is interest under section 234A. Right? So that interest cannot be claimed as the, interest will be charged under section 234A. Now, interest under 234A is how much? It is 1% per month or part of month. So even if you, let's say, file by 1 day, late 1% interest for the month, part of the month will become applicable. So interest is applicable 1% per month from the period commencing immediately after the due date expires till the date of furnishing the return of income. And if you do not furnish the return of income, then till the date of completion of assessment. So 1% per month from due date till date of furnishing the return of income or completion of assessment. Are we clear? Now this is applicable. This interest at the rate of 1% is applicable only when the tax is payable. Understand that. If there is any tax is payable. If there is no tax payable, then of course the interest will not apply. If let's say for example you have paid your taxes entirely, then in that particular case there is no balance tax which is payable, then interest will not be applicable. So interest has to be calculated on the tax payable. If there is no tax payable in your return, interest will not be applicable. Interest under section 234B and C which is there, that is applicable for the short payment and late payment of advance taxes, Simranjeet. So interest under 234A which is there, Simranjeet, that is for the late filing of return. If any tax is payable in the return, then only interest under 234A is applicable. Interest under 234B and C, Simranjeet, is particularly for short payment and late payment of advance taxes. Okay? So this is on tax payable. You can write down here, if no tax payable, interest under section 234A is not applicable. Secondly, penalty under section 234F. You have penalty under section 234F. Namrata, if after rebate there is no tax payable, then interest is not applicable. If there is no tax payable, Namrata, if your entire TDS has been deducted, you have paid the entire tax by way of the advance taxes, then you are not required to pay any interest under 234A. So as I said, it is payable only when there is some tax payable by the assessee. If there is no tax payable, interest will not be applicable. Okay? 234F. The penalty under 234F. What is the penalty under 234F? There are two penalties. Total income less than rupees. Yes. How much? 5,000 is when? And when there is 1,000, there are two penalties which are there under 234F. So if my total income is less than rupees 5 lakh, if my total income is less than equal to rupees 5 lakh, the penalty is under 234F. There is a fee which is there. This is how much? 1,000. Rupees 1,000. And if my total income exceeds rupees 5 lakh, then the penalty is rupees 5,000. Okay, so this is the penalty that I will have to pay. Clear? Yes or no? Then there can also be prosecution. So not only there is the late fee, but in cases which are basically of the resulting in tax evasion kind of situations, there can be prosecution initiated. There can be even the prosecution initiated on the assessees. Are we getting that? So it is not just that you will have interest consequences, but you will also have the consequences of initiation of the prosecution, where there is a willful failure to furnish the return of income. So there can be prosecution if the tax evaded, if evaded tax exceeds rupees 25 lakh. Of rupees 25 lakh, then there could be prosecution which can be initiated by imposition of fine, and there can be prosecution of 6 months to 7 years. So 6 months to 7 years of jail you can have. Are we getting that? And in other cases, if my tax evaded is less than equal to rupees 25 lakhs, then in that case it is 3 months to 2 years. Are we clear? Yes or no? Yes or no, students? So the prosecution will not be initiated if, let's say, for example, you have furnished the belated return or an updated return. Are we clear? So the prosecution which is there will not be initiated if you furnish the updated return or the belated return. Okay? So just write down. If prosecution shall not be initiated if return of income is furnished, belated, or an updated return is furnished, or the tax payable does not exceed rupees 10,000, or tax payable less than rupees 10,000. Tax payable after reducing, of course, the advance tax, SA tax in the return of income. If your tax payable is less than 10,000, then also the prosecution will not be initiated because that is a very smaller case. Yes, students? Then what are the other consequences? You can just make like this if you want. Prosecution, if my tax evaded is greater than rupees 25 lakh, and here you can write if my tax evaded is less than rupees 25 lakh. Then it is 6 months to 7 years. And in this case, it is 3 months to 2 years. Okay? Fine. Yes or no? What are the other consequences? Carry forward and set off of losses not allowed except income from house property loss or unabsorbed depreciation. Secondly, non-allowability of Chapter 6A deductions linked to profits or Section 10AA deduction. Third, what else? You cannot change your scheme of taxation. You cannot opt in for 115 BAA, BAB, BAC, BAD, BAE. You cannot change your tax regime. You cannot opt out or you cannot opt in the new tax regime. Are we getting that? So, tax regime, or you can write that tax regime cannot be changed. So that is very, very important. Yes, Simranjit will not be able to take the benefit of new tax regime. Shankara, the prosecution will not be initiated on family members if there is death of assessee. If there is death of assessee, the assessee has died, the prosecution will not be initiated on family members. Namrata, tax evaded means that the tax that was due to be paid by the taxpayer, he has evaded that tax. He has not paid that tax. He has kind of avoided that particular tax by not filing the return of income. He has not disclosed that income, the tax on which was due to be paid. And that is tax evasion, Namrata. Namrata, after rebate, there is no tax payable, then interest is not applicable, as I said. Yes, Mansha, scientific research expenses can also be carried forward even if the returns are not filed on time. You're right. Okay? Yes or no, students? Is this clear? Fine. So these are the consequences if you do not file your return of income on time. So that is the section 139(1). Now there are certain exemptions from 139(1). There are specified class of persons who are exempted from filing the return of income. Who are they? So the central government has issued a notification exempting the non-residents or the foreign companies having the income from the investment fund which is set up in the IFSC. So they are exempted from furnishing the return of income. These kind of non-residents or the foreign companies, if they are earning the income from the investment fund. What is the meaning of investment funds? So investment funds are basically set up as the AIFs. We have spoken about what are AIFs, right? So if the non-resident or the foreign company are earning the income from the AIFs set up in the IFSC and the TDS has been duly deducted under 194 LBB and there is no other income on these person and no scrutiny has been initiated on them, then in that particular case, they are not required to file the return of income. That is number one. So a non-resident or a foreign company is not required to furnish the return of income if they are earning the income from the specified fund or the investment fund which is set up in the IFSC. Clear? Yes or no? Or the non-resident who have the capital gain arising from ADRs, GDRs, which are again listed on the recognized stock exchange, listed on the IFSC. They are also not required to furnish the return of income. So just write down exemption from return of income. Number one, non-resident or the foreign company, non-resident or foreign company having income from AIF set up in IFSC. AIF set up in IFSC where TDS under section 194 LBB is deducted and no scrutiny notice has been issued. Non-resident having capital gain on GDRs listed in IFSC. Having the GDRs listed in the IFSC. So they are not required to furnish the return of income. Yes or no? Any questions? Any doubt? Yes? So these persons are not required to furnish the return of income basically. There are other persons also who are not required to furnish the return of income. And who are these? I'll tell you. Number one is if there is the income which is in the nature of dividend, interest, royalties, fees for technical services, and the TDS has been duly deducted on these particular income as per section 115A, then that non-resident is not required to furnish the return of income. Then that non-resident is not required to furnish the return of income. So the TDS should have been duly deducted. Secondly, there are certain AIFs. There are certain AIFs. The income, if it is earned from the AIF by the non-resident, then also they are not required to furnish the return of income. Okay. So, non-resident having income from AIF. Third is non-resident having dividend, interest, royalties, FTS, and TDS is deducted as per section 115A. Yes, in these cases, the income tax returns are not required to be furnished. These exemptions are given specifically for the non-resident from filing the return of income. Are we clear? So these are given to the non-resident and not to all the assessee or any other assessee. These are not given to any other assessee. These are only given to the non-residents. Be very clear about it. Are we clear? What are the other or who are the other taxpayers who are not required to furnish? A non-resident, if his total income consists of the capital gain arising on the ADRs or GDRs, capital gain arising on the ADRs or GDRs, then in that particular case, and if the TDS has duly been deducted, then in that particular case, he is not required to furnish the return of income. So a non-resident having capital gain on the GDRs and TDS is deducted, then in that particular case, the return of income is not required. Again, this is the exemption which has been given to a non-resident. Are we getting that? Secondly, in the case of the sports person or the entertainers, in the case of the non-resident sports person or the entertainers, again there is the exemption which has been given. So again, they are not required to furnish the return of income if they have the income from the sports advertisement in India and the TDS has been duly deducted. So in case of non-resident sports person or entertainer and TDS is deducted as per section 115 AC, sorry, 115 BBA, having income referred to in section 115 BBA. Okay, where the TDS is deducted, then in that particular case, you are not required to furnish the return of income. Yes, these exemptions, Mansha, are given to only non-resident. For ROR, global income is taxable. NOR, RNOR also, these exemptions cannot be claimed because these particular reduced tax rates are applicable only for the NR. And these exemptions come through these particular sections, which is 115A, 115 BBA. These are not coming through 139. Shankara, no worries. You can ask as many doubts that you have. Happy to answer all your questions. Namrata, as I said, you are not required to file the ITR, but if you want to claim refund, you have to file ITR. There is no other way to claim the refund. So even if you are not required to file ITR, you can go and suo moto do that. There is no harm. Let's say, for example, I don't have income. That day, I was coming through car, right? And then I was speaking on phone because it was this was on 20th of December, right? And on the 31st of December deadline was approaching. So I was talking on my phone and my driver overheard me. I was talking to the clients regarding filing their return of income by 31st December. As I said, e-campaign notices are received and lot many clients were calling up that we have not filed the return. What should we do now? So my driver was hearing this particular conversation that I was having with my clients. Now my driver said, "Ma'am, I want to take a housing loan, but I've never filed the return of income. Am I mandatorily required to file the return of income?" I said, "What is your salary? How much do you earn in a year?" He said, "I earn less than rupees 2.5 lakh. I said, "But if you want to have the housing loan, you need to submit 3 years ITR. Now, if he has to submit the 3 years ITR, he's not required to do that." But he said that, "Ma'am, since I want to take the loan, can you please file the ITR for me also if the due date has not passed away?" I said, "Of course you can do that. But there will be penalty under section 234F of rupees 1,000. Are you ready to pay?" He said, "Yes, ma'am, I'm ready to pay." He filed the ITR for last year. So moto he did that despite having the total income less than the basic exemption. And he had certain even refund of taxes also. He didn't know that some TDS was deducted by the company by Zomato because he was also working with Zomato. So he went ahead and he filed the return and claimed the refund of taxes also. Isn't it? So it is possible. I can go ahead and do it voluntarily as well. Shankara, if you have not filed the return for 5 years, you cannot file now. You can only do it for last 2 years, that too an updated return. Okay? Yes or no, students? Any questions? Fine? Okay, let's proceed further. Now this is 139.1. Now for the charitable trust. For the charitable trust, they are also required to furnish the return of income. They are also required to furnish the return of income if the total income exceeds the basic exemption limit. So, you can write it here. For the charitable trust that is not under 139.1, but this is under 139.4A. The charitable trust, they have to furnish the return of income if their total income exceeds the basic exemption limit. So again, charitable trusts are not mandatorily required to furnish the return of income. But let's say, for example, if they want to claim this exemption under 11 and under 12, they have to file the return of income within the due date under 139(1). If they want to claim the exemption under section 11 and section 12, then they have to furnish it by the due date under 139(1). Are we getting that? And they are also required to get the books of accounts audited if their total income without claiming the exemption exceeds the basic exemption limit. In that case, they are required to get the books of accounts also audited. Are we clear? So just write down over here. Exemption under section 11 and 12 can be claimed if return of income is furnished by due date under section 139(1). Now, what will be the due date for the charitable trust, students? We have just now done the charitable trust class few weeks back. What is the due date, students? What is the due date of trust right for the charitable trust? What is the due date? Yes, students. What are the due dates of the return of income? So you have just done with your charitable trust class, right? What are the due dates? Yes, Mansha, we are going to talk about updated return. Thank you, Shankara. I'm really thankful that you liked the class, as you found the class very interesting. Some are saying 31st July, some are saying 31st October. Mansha is saying 31st October. Yes. Tariq 31st July. Yes. Whether it's 31st July or 31st October or it is both. Yes. What is the due date for the charitable trust, students? Go back to charitable trust class and tell me the answer. Yes, students. So the return of income, it says you have to furnish within the time allowed under 139(1). But under 139(1), there are several due dates. So which due date? 31st July, 30th October, 31st October? Yes or no? If you do not furnish the return of income, yes, you cannot claim the exemption under section 11. You have to mandatorily file the return of income in order to avail the exemption in the either 1023C or under 12A. So entities registered under first regime or second regime, both are required to file the return of income within the due date of return of income if the total income exceeds the maximum amount which is not chargeable to tax, and in case they want to avail the exemption. Yes, but I'm still not getting the answer for the due date. Okay, so understand this thing, where the total income of the trust either under the first regime or under the second regime without giving effect to Section 11 and Section 12 or 1023C. If it exceeds the maximum amount which is not chargeable to tax, meaning the basic exemption limit, then these charitable trusts are required to maintain the books of accounts and get the books of accounts audited. They have to get the books of accounts audited and they have to maintain the books of account. So in these particular cases, the audit, if the audit is to be done, if the audit needs to be done, then the due date will be 31st of October. If the audit is not required to be done, then in that particular case, the due date will be 31st of July. Are we clear? So there are different due dates which are applicable over here. And in case you do not furnish the return of income by the due date, as I said, you will not get the benefit of the deemed application if you accumulate the income. So you will not get the benefit of the accumulation of the income, and then you will not have the deemed income, deemed application. So in case you do not furnish the return of income, the benefit of accumulation will not be available to you. Yes or no? Is it clear, students? Yes. In case you fail to file the return of income, in case you fail to file the return of income within 139(1) or a belated return, then in that particular case, the income shall be chargeable to tax. The income shall be chargeable to tax. You will not get the exemption under 1023C or Section 10 or Section 1023C or Section 11 or Section 12. Is this clear? So just write down over here. Total income. You can write here before claiming exemption under Section 10, 23C or 11 or 12. Fine. If you have the total income greater than the basic exemption limit, so if you have furnished the return of income by the due date under 139(1) or 139(4), which is the belated return. So you can claim the exemption even when you file the belated return. It is not necessary that you will have to file the return under 139(1) only, but you can claim the exemption even when you file the belated return. So you have to file the return of income if the total income exceeds the maximum amount not chargeable to tax, which is a basic exemption limit. However, accumulation of income not available if return of income is not furnished by the due date under Section 139(1). Accumulation of income not available. Therefore, accumulation of income shall not be considered as deemed application. Okay, you can write here audit required if total income without exemption under section 1023C, 11 or 12 exceeds the basic exemption limit. In this case, the due date will be due date if audit required will be 31st October. Due date will be if audit required, it is 31st October. Are we clear? So you are required to file the return when your total income exceeds the basic exemption limit. So obviously, if your total income is exceeding basic exemption limit, you're also required to do the audit. Now, if you're required to do audit also, then of course your due date will become 31st of October. Yes or no, students? Yes, Simranji. Otherwise, if you want to file voluntarily, you can do that by 31st of July. If you just want to claim exemption, and you can do it by 31st of July. It's not tax audit, it's just the audit required for the charitable trust tally. Yes or no, students? Fine. Then there is income of the political party, the return of the political party. Sorry, not the income, the returns for the political parties. For the political parties also. So they are also statutorily required to file the return of income if they want to claim the exemption from the income from the political party. Now they are required to file the return of income only when the income exceeds the basic exemption limit. So the total income before exemption under section 13A exceeds the basic exemption limit. So then these political parties are required to furnish the return of income. And they can only claim the exemption under 13A subject to the condition that they file the return of income within the due date of 139(1). So here the audit is mandatory. The audit is mandatory. The audit here is mandatory. To claim exemption return of income by the due date under section 139(1). Okay. And here the due date, since the audit is mandatory, due date will be 31st of October. Due date will be 31st of October. Are we clear? Yes or no, students? Any questions? Any doubt? Yes? Then who are mandatorily required to furnish the return of income? Research associations, news agency, trade unions, then mutual funds, securitization trust, venture capital funds, universities, then business trust, InvITs. Instead of business trust, you can also write here REIT. They are mandatorily required to furnish the return of income. Okay. So for them, it is mandatory to file the return of income. Okay. Fine. Yes or no? Any questions? Any doubt? Yes or no, students? Now, this is the due date of furnishing the return of income. Namrata, audit is mandatory for the political parties and for the charitable trust if their total income exceeds the basic exemption limit. For normal companies, the audit is mandatory. They have to get the stat audit done. And otherwise, for all other assessees, the tax audit is required, including the company. Now, the tax audit requirements are 1 CR, 10 CR threshold, which is there. So, in those cases, the due date will be 31st of October. Which last point, Namrata? Okay, students. So now these are the due dates under 139.1. Now let's say, for example, if you're not able to file the return by your due date, you have an option to file a belated return. You have an option to file the belated return. The belated return can be filed by 31st of December. So belated return can be furnished belated return by 31st of December. So you can furnish the belated return by 31st of December. And you can also revise the return. In case you have made certain errors or you have committed certain mistakes, you can revise the return again by 31st of December. By 31st of December. So you can file the belated return or the revised return by the 31st of December. You can revise all of these returns, but cannot revise the. Can you revise the belated return? Yes. Can you revise the belated return as well? Yes or no, students? So you can revise the normal return or the returns which are furnished by the charitable trust. But can you revise the belated return? Yes or no? Can belated return be revised? Yes. Belated returns cannot be revised. Yes, Namrata, political party, they have mandatory audit irrespective of income. Okay. So belated returns cannot be revised. Then you have let's say for example, you have losses. Then you have a loss return. Now, as I said, you cannot claim the carry forward and set off of the losses unless you file the return of income in time. So which are the losses? So section 80 mandates that if you have a return of loss, then you are required to file the return of income by 139.1 by the due date under 139.1 in case you want to claim the losses, in case you want to carry forward the losses. Business loss, speculation loss, capital losses, losses from owning the, maintaining the race horses, or the specified business losses. So you have, if you have those losses, if you want to carry forward, you have to file by the due date. In case you do not, then your losses will lapse. But income from house property loss or the unabsorbed depreciation can even be carried forward and set off even if you do not file the return of income on time. Yes. So we'll take a break over here. How many times you can revise the return? Namrata, you can revise n number of times. Till 31st December, if you want to revise, you can revise. But there is only one problem, that if you file your revised return, then it may be subject to scrutiny notices. So it is not surely going to be, but it obviously kind of reflects into the income tax department system that this particular notice can lead to risk since it has been revised, and therefore the scrutiny can be there. So it is better that you do not revise the return multiple times. Okay. So we'll take a break over here, and after the break, we'll start with the updated return. So let's call for a break over here. as well as for the charitable trust, REITs, InvITs, all of those returns which are considered as return filed in a 139(1) can be revised. Okay. Now, as I said, let's say, for example, you have not furnished the return of income even by 31st of December. You have an option to furnish the return, which is called as the updated return. This is the updated return, which is a new category which was introduced last year, which is kind of a voluntary disclosure scheme. Something like that we had even under the COVID era, wherein it was called as Vivad Se Vishwas scheme, right? It's something similar to that you have got now an opportunity for 2 years from the end of financial year to furnish an updated return. You can furnish an updated return voluntarily disclosing your income. So that is called as the updated return. Now, what is the scheme of this updated return? Let's try and understand exactly how does it work. So for the updated return category, first of all, it cannot be furnished by everybody. There are certain conditions with regard to the updated return. And what are those? Let's try and understand. So in case of the updated return, the assessee has the option to furnish this particular updated return within 24 months from the relevant assessment year. Meaning, now for this particular financial year, you can file the updated return. So this assessment year is going to be 24-25, right? So you're into 23-24 financial year. So the assessment year is 24-25. 24 months from that, you have time till 31st March 27 to file the updated return. Isn't it? So you can file the updated return by 31st March 27. You have 24 months time limit. This is irrespective of whether you have furnished a return under 139.1, under 139.4, under 139.5, which is the original return, revised return, belated return, or you have not furnished any return. So even if you have not furnished, even if you have furnished and you want to disclose additional income now, you can file the return of income, which is the updated return. This is under section 139(8)(a). Can be filed even if return already furnished under section 139.1, 139.4 or 139.5. That is belated or revised return. Okay. Now this is not applicable to the updated return cannot be filed if it is a loss return. If this is a loss return or has the effect of reducing the total income or the total tax. Effect of reducing the total tax already furnished in the return of income filed earlier, or increasing the refund, or increasing the refund. Reducing the tax or increasing the refund. Reducing the tax or increasing the refund. So in these cases, you cannot file the updated return. Are we getting this point? So an updated return can only be you have the when you do not have the losses or when you don't have the effect of reducing your tax or increasing your refund. Also, the updated return cannot be filed where the search operations have been initiated or where a survey has been conducted on the assessee. So in these cases, the updated return cannot be furnished for the particular year in which the search is initiated or survey is conducted, or where a notice is issued to the assessee to say that any money, bullion, jewelry belongs to this particular person, or any books of accounts are belonging to this person or relating to this person, to the assessee. Or let's say, for example, any reassessment proceedings have been issued or any assessment proceedings are already going on. Or let's say, for example, the assessing officer has information that the person is involved in the smuggling or any foreign exchange manipulation or prohibition of benami property transaction or Prevention of Money Laundering Act or the Black Money Law. So in these cases, the updated return cannot be furnished. Or where, let's say, for example, the information has been received under the foreign exchange agreements, under the, double tax avoidance agreement, or the prosecution proceedings are initiated. So, mean all the kinds of tax avoidance, if the assessee is adopting any kind of tax avoidance mechanism, then in these cases, the updated returns cannot be furnished. Are we getting? So you can write down where search has been initiated, where search or survey has been initiated, where assessment proceedings are pending or completed. So where any assessment or reassessment proceedings are pending or completed, where the AO has information, where the AO has information under Smugglers and Foreign Exchange Manipulators Act, Foreign Exchange Manipulators Act, Prohibition of Benami Property Transaction Act, then Prevention of Money Laundering Act, PMLA, then Black Money Law, BML. So in these cases, the updated return cannot be furnished, or where information is received under the DTL. . under the DTL, or if prosecution has been initiated. Okay. So when you cannot furnish the updated return, when you have a loss return, when it has the effect of decreasing your tax, which you have already disclosed in your original return, revised return, or belated return, or has the effect of increasing the refund, or where the information is received under these tax evasion or the kind of acts which are prohibiting these Benami transactions, or under the DTAA, or any prosecution proceedings are initiated. So updated return can be filed even if original return has been filed, a loss return has been filed, or a return has not been filed. So you will be allowed to file the updated return. Are we clear? However, let's say for example, if it is a loss return, let's say it is a loss return. Mansha, it is not retrospective return. It is not at all retrospective. How come it is retrospective? It's not retrospective. Let's say, for example, if it is a loss return that I have filed under 139(3), a return of loss. Now, can I file the updated return? Answer is, if I want to claim additional loss, I cannot file the updated return. But let's say, for example, if I want to convert the loss to the income, then I can file the updated return. So if the original return is a loss return, and now the updated return should be a return of income, only then I can file. So if it is a loss return, here you can write down, however, if the original return is loss return and updated return is return of income, updated return can be filed. So if it is a loss return, it's not necessarily you cannot file the updated return at all. You can file if you're converting the loss to the income. Namrata, example of information under DTAA. Namrata, when you will go to international tax class, I'll explain you about that. But just to keep you very brief at the moment, under the DTAA, the countries agree that they will share the information with each other regarding their residence. So what happens, let's say for example, if I have certain assets outside India, now the other country will share that information with India that look, this resident has these many bank accounts outside India, these many assets outside India. Now, if I file in my return of income, if there is a schedule for disclosure of foreign assets, if I disclose those assets, then it is fine. If I am not disclosing those assets, then the income tax department will ask me that we have received this information from the other country and you have not disclosed these assets, you have not disclosed the foreign income in relation to these assets, please explain it. So that is the kind of information that flows through the DTAA. Yes, Namrata, in short, you're right. If the assessee is getting some benefit by filing the updated return cannot be filed. You are absolutely correct. Okay. So now in the case of the updated return, let's say for example, if this year I'm filing the updated return. Now because of that, let's say my loss is getting reduced. Okay. And let's say for the next year also, let's forget like for this year, let's say for example, let's take an example. Let's say for financial year 21-22, I had a loss of rupees 3 lakh. I carry forward this loss and set off for 22-23. Right? Now for this year, I'm going for updated return. And I'm disclosing, let's say, income of rupees 5 lakh. So this year, I'm filing the updated return. Now for the next year, since I have claimed the loss and now I'm converting to income, I have to also file the updated return for this year as well. So if the loss or unabsorbed depreciation or any tax credit has to be reduced for the next year as a result of furnishing the updated return for this particular year, then updated return is to be furnished for each subsequent year as well. Are we clear? Now, when you are filing the updated return, you need to pay the tax, interest, and the late filing fee. So, tax on updated return, section 140B. Where no ROI furnished earlier. Where the ROI is not furnished earlier. Then you need to pay the tax along with interest and fee which is applicable for furnishing the updated return which is to be filed. Okay. So assessee will be liable to pay tax, interest and fee. For interest will be under 234A, 234B and C for the advance tax delay which is applicable, and then the fee under 234F. Now this tax will be along with tax plus the additional tax. Okay. Plus interest under section 234A, B, C, plus fees under section 234F. Okay. Now here, how will you compute the tax? The tax payable will be whatever tax you have minus the advance tax, TDS, TCS, any kind of rebate that you have, any kind of double tax relief that you are getting, the foreign tax credit, any MAT, AMT credit, all of that, reducing that, whatever tax will be payable, you have to pay that first. And the interest on that tax payable will be calculated under 234A. Are we clear? So on the tax on the total income, which is payable by the assessee as computed, as declared in the updated return, on that you will have to also pay 234A interest. And in case the return of income is furnished earlier, where the ROI is furnished earlier, either under as a original return, revised return, belated return, then the assessee would be liable to pay the tax along with the interest and the fee which is payable, interest under 234 BC, as reduced by the interest already paid in the earlier return. So what you will do is, you will calculate the tax here, but you will reduce the tax which has already been paid earlier, either as TDS, TCS, or any kind of tax which is already paid by you earlier, self-assessment tax, any FTC, MAT credit which has not been claimed earlier. So all of that you will reduce, and that will be increased by the interest under 234B where return has already been furnished. In case where the earlier return has been furnished, the interest under 234B has to be computed on the assessed tax. On the assessed tax, meaning, so what you will do is here, how will you compute it? The tax payable has to be computed by tax due minus TDS, TCS, which has not been claimed in earlier return, FTC, foreign tax credit, and MAT or AMT credit. So these should not have been claimed earlier. Okay, these should not have been claimed earlier. And increase by the refund, if any, claimed in earlier return. Because you cannot increase the refund, you can convert refund to the tax. Are we getting this particular point? So where a return has already been furnished, the assessee would be liable to pay the tax together with any interest which is payable along with the additional tax. So then in that particular case, you will be required to reduce the TDS and TCS, if any, which is not claimed earlier. If it is claimed earlier, then you will not consider that in this particular TDS TCS. Are we getting this particular point? And any tax that you have already paid in the original return, that you will reduce. Tax paid in earlier return. Because in the earlier return, you would have already claimed the TDS, TCS credit earlier return, you would have already paid the TDS, TCS, you would have already claimed the TDS, TCS credit. Now, whatever you would have not claimed at that point of time, you can claim it now. Because what you are doing is you are reducing the tax paid in earlier return. So, which is after considering all the TDS, TCS, advanced tax, ALT, MAT, FTC, everything. So, again, you will not reduce TDS or TCS. You will only reduce the credits which are not claimed in the original return. And you would add back the refund, if any, which has been claimed in the earlier return. Okay. On this, you will calculate the interest under 234B. Interest under 234B. Now, what would happen? Let's say, for example, you have the tax on the total income as declared in the updated return. From that, you will, of course, reduce the tax paid in the earlier return minus the TDS and TCS, which is not claimed in the earlier return, minus any FTC, minus any AMT or MAT credit. On this amount, you would calculate the interest under section 234B. And similarly, you have to calculate interest under 234C. Okay, so you will calculate the interest under 234B, 234C additionally, which will be on the new tax which is there, of course, after reducing all these credits, and plus you will have the additional taxes. Now, what is the additional tax? So, if the updated return, if my updated return if the updated return is furnished before the completion of 12 months, before 12 months from the relevant assessment year, then it is 25% of tax and interest payable. Tax and interest both, 25% additional tax and interest you will have to pay. And if it is furnished after 12 months, but before 24 months, because the time limit is 24 months from the relevant AY, then you have the additional taxes, 50% of tax and interest payable. Now, this tax would include the surcharge and cess. Are we clear? This will include the surcharge and cess, everything after that, whatever the tax is coming, including surcharge, including cess, and the interest which is payable under 234A, B, and C, as reduced by the interest paid earlier. On that amount, you will have the additional tax. Are we clear? So, let's say, for example, let's take an example to understand this. Let's say where return of income is not furnished. In this, it is very easy. You will have this particular tax, interest under 234 ABC, fees under. So this additional tax will not be on fee. This is only on tax plus the interest. So on this amount, you will calculate the additional tax. But let's say, for example, if I have furnished already the return of income, and let's say my tax payable comes to 50,000. Okay, tax payable comes to 50,000 in the updated return. Let's say in the original return, I have paid tax of, not original, I'll write it over here, earlier return. Let's say in the earlier return, I have paid tax of 10,000. So I will reduce the 10,000 from here, plus interest I had paid off, let's say rupees 5,000. Okay, so this comes to, let's say, 40,000. Okay, let's say here my interest under section 234A, B, C combined comes to 10K. Okay, so I will reduce the interest paid earlier, 5,000. So how much it comes to? This comes to 45,000. On this amount, you will pay the additional tax. So on this amount, the additional tax will be applicable. Are we clear? Yes or no, students? Did you get that? Namrata, foreign assets do not get disclosed in AIS. Namrata, we add the refund because if you have claimed any refund earlier, so that is added back. See, if you had paid any taxes, you are reducing it. If you have claimed refund, it will be added back. If there is no tax payable, Namrata, if the income is, let's say, rupees less than 5 lakh, or let's say entirely tax has been paid by way of TDS, and then there is no taxation now. Let's say I have not furnished, like yesterday I furnished one return of income for my client, wherein he had never filed the return of income. But whatever income he had paid it, all the taxes he had paid by way of TDS. All the TDS was deducted, the TDS was entirely deducted. So there was no additional tax payable, but he filed the updated return for financial year 21-22, and then there was no additional tax payable. So additional tax payable will come only when there is tax payable. If there is no tax payable, there will not be any additional tax. There was only late filing fee. Clear, Namrata? So only if I have the tax payable, only then I will have the obligation to pay additional tax. So additional tax works like a penalty. Since you have not disclosed it earlier, you have to disclose now. Now you may ask, ma'am, why then we should go for updated return? To save yourself from the penalty which could result for non-reporting, for under-reporting or misreporting of income under 270A, which we will learn in subsequent classes. Because if you do not file the return of income and the AO initiates the reassessment or assessment proceedings, he may charge the penalty for under-reporting or non-reporting of income. In which case, the penalty is as high as 50% of the under-reported income to 200% of the income. So to avoid that consequences, you can go for the updated return and pay this additional tax. This additional tax works like a penalty. Any question, student? Yes, any questions, any doubt? Yes, let's take up one question from the module so that you get an idea exactly how this updated return works. I'll take up this question from the module itself. So you're required to solve this question. Mr. X would like to furnish his updated return for financial year for the assessment year 22-23. In case he has furnished his updated return of income, he would liable to pay 2,50,000 towards tax and 35,000 towards interest after adjusting tax and interest paid at the time of filing the earlier return. You are required to examine whether Mr. X can furnish updated return as on 31st March 24, 28th February 25, 31st May 25. If yes, compute the amount of additional income tax payable by Mr. X at the time of filing his updated return. Would your answer be different with respect to filing of updated return in case of point 2 above, where he has received a notice under 147 for the said assessment year 22-23 on 23rd July 24? So let's go one by one. In the first case, 31st March 2024. Namrata, differentiation between penalty on underreporting of income is that is a penalty. This is a tax that you are paying. So the difference is that if you are subject to penalty, then that is something which results in the penal consequences in terms of the highest amount of penalty that is levied is 50% of your tax on underreported income. So that is something which is a penalty. This is considered as tax, although it is named as tax, but this is something like penalty which you are voluntarily paying by yourself for not declaring your income earlier. Yes, Namrata, I'll summarize after this question. Yes, 71250, 25% of the tax which is there. So 2,50,000 and 35,000 together comes to 2,85,000. So 71,250 if it is filed by within 12 months by the 12 months from the relevant assessment year. So 25% of 2.5 lakh plus 35,000. What about 20th February 2025? Yes. Yes, Namrata, 1,42,500. That's correct. And in the third case, yes, in the third case, it cannot be filed, yes, correctly after 24 months. So in this case, it will be 142,500. And what if the reassessment notice has been received? What if the reassessment notice has been received? Yes, Mansha, you are right. What if the reassessment notice has been received? The second part of your question. Yes, students, faster. Not eligible for updated return. You are right, Mansha. If the reassessment notice is received, then you are not eligible for the updated return. You are correct. So in this case, it is not eligible for updated return. And in this case, this is the time limit expires. Okay, student. Now I'll just quickly recap what we did about the updated return. As I said, updated return can be filed from the period of relevant AY for 24 months. Okay. So it can be filed even if you have filed the original revised or belated return, or even if you have not filed. This is not applicable to a loss return. So if you have a loss return, you cannot file updated return unless you wish to convert your loss to the income. And in case you convert your loss to the income and the subsequent years returns also gets affected because you have claimed those losses in the subsequent years, then you are required to file the updated return for all of those years, wherever the loss has been claimed or wherever any tax credit has been claimed, which is getting impacted now, or if it is having the effect of reducing the total tax or increasing the refund which has been claimed in the earlier return, or where search or survey operations are conducted, where any assessment or reassessment proceedings have been initiated or are pending or are completed as well. So even if the reassessment proceedings for that year are completed or the assessment proceedings for that year are completed, still you cannot file the updated return. Are we clear? Because the assessment has already been closed for that year. So now you cannot file for that year. Or it is pending also, you cannot file for that year. Or where the AO has information from the different acts which results in the kind of Benami transaction or under DTAA, or the prosecution has been initiated. In these cases, you cannot file the updated return. Now, in case you file the updated return, if you have not furnished the ROI earlier, then you have to pay the tax and the interest and the fees in this particular return. In case you have furnished the ROI earlier, then you have to pay the tax. After reducing the tax paid earlier or refund which you have claimed earlier will be increased. Okay. Now, whatever tax payable comes in this particular return, along with the interest, I'm not talking about the late filing fee, I'm talking about the interest. Here you also write it about fees under section 234F. I'm not written over here, so just write it down. So considering the tax, whatever is payable and the interest, so the additional tax will be on the tax and the interest payable. If you are filing the updated return within 12 months from the relevant assessment year, then 25%. And if it is after 12 months, then 50%. Are we clear? In case there is no tax payable in your updated return, then additional tax will also not come. Additional tax will come only when there is tax payable in the updated return. Clear, students? Sorry. Yes or no? All of you students, please, I need the answers. I'm not seeing answers from all the students. This is very, very important topic. Updated return. Yes, students, I need answers before I proceed further. Yes or no, everybody? I'm not getting responses. Everybody's so active when once the class start, okay, and then after that you just kind of go away, I feel. Only then few students remain. Is that so? By the time it's 6:37, everybody is active. After that, many students are gone. I need answers, yes or no, quickly. Students, please be with me. These are very, very important topic. Please, please, please. Yes or no? Understood? Okay, fine. So let's proceed further. Yes, good, Mohammed. Just be responsive, give your answers, put your answers in the chat box so that I know I can correct you. Subsequent updated return point not clear, Namrata. Okay, I'll repeat it. So, Namrata, what did I say is that let's say, for example, I gave you the example here also. Let me take that example again. See, if for the financial year 21-22, I had a loss of 3 lakh, and in 22-23, I have claimed that loss against my income. Now, let's say for 21-22, I am going for updated return. Then I am converting the loss to that income. So now that loss no more remains. So I also need to file updated return, Namrata, for even 22-23 because I need to even remove that loss from the income of 22-23. So updated return for both these years are required. Are we getting that, Namrata? Is that clear? Mansha, yes, they are sending the notices to the returns filed in last 10 years. Even a completed assessment, yes, Mansha, we are going to learn about that as well in the next class, which is the reassessment. I'm only getting answers from Mansha and Namrata. I'm not getting answers, no queries, no yes or no also. I think all the students are not present or they are not answering. See, if you will answer, your points will get more clearer. You will not be making mistakes in the examination. If you do not answer, students, and you are just listening to me, there are high chances that you might end up making the mistakes in the examination. So as I am saying you, please, please, please answer, ask the questions so that I can help you out so that you do not make the mistakes in the exam. Are you with me? Yes. Okay. So let's proceed further. Now we are discussing some other topics which is relating to PAN and all of that. So all of you just be with me again. Those are very small, small areas, but important enough because these could be asked as a smaller questions. Okay. So do not miss out on those particular questions also. So it is important to just know these questions. Okay. So let's discuss. Now, before we move further, just one thing I just wanted to ask you. Where are these forms of return filing given? ITR 1, ITR 2, ITR 3. Where is that given? Yes, do you know that? Who is required to file ITR 1, ITR 2? Where is that given? Yes, anybody knows that? Namrata, the logic of completed assessment not allowed is that completed the assessment once it is completed. I have done your assessment. Now I cannot, now you cannot say that now I again want to file some income by disclosing certain income. Assessment done is meaning, see, understand or link it with the kind of examination that you give. We are writing your paper. Okay. Now, once you're writing your paper, let's say, for example, you feel that you have not written correctly. You may plead that, okay, I want to revise my paper. You may want to revise your paper. Or let's say you have not set for the paper, you will say that I will sit for the next attempt. But once I have checked your papers, even if you have, let's say, for example, not appeared for paper, I call you and I tell you that, okay, now you sit for the examination and I complete your assessment. Then again, you cannot say that I again want to reappear for examination. It's the same thing. Once we have done your assessment, the AO has checked entirely, thoroughly, everything. Now, then you cannot say, I want to disclose certain income because you had the chance to disclose the income during the assessment stage. Are we clear? Yes, Mansha, you are correct. The return filing forms which are there are given in income tax rules. Yes, Namrata, it is given in rules. Not only on website, on income tax website, everything is given, even the act is given. But yes, that comes as the part of rules. So the section does not provide that, but the rules which are there under 139A allows the CBDT to issue the rules which are there. So the CBDT can issue the rules, and the return of income are forms filing which are there. The return of income forms which are there are issued through those rules. Okay. So there is this rule 12. There's rule 12AB, which provides for the return of income filing forms. That who has to file in ITR 1, who has to file in ITR 2, that you can find through the rule 12. And it is very important to select the right ITR, because nowadays what happens is you only go through the software. The software allows you to select ITR, but you don't apply your brain, because it just kind of gives you the correct ITR by selecting by itself. So you don't apply your brain to that you don't read the rule as to whether the software is selecting the correct ITR or not. Because there are chances that it may select a wrong ITR based on the information that you have not given to the software. It is very important to select the correct ITR, because if you select wrong ITR, you may not report the information which is required to be reported in the correct ITR. Are we getting that? So it is very important you first read those rules properly, apply your own mind, and then rely on the software. Do not just mechanically rely on the software's work that, okay, this is the idea that it has automatically selected for me and it will be right. So go to rule 12 and identify whether the ITR is correct or not. Are we clear? So you go to ITR, go to the rule 12, sorry, and then see whether ITR 1 is applicable, ITR 2 is applicable, 3 is applicable, which one is applicable to you. Clear? Is that fine? Okay, now we are moving towards the requirement of obtaining the PAN. So that we are going to take care from the module itself, because these are certain procedural requirements. So I'm just viewing the screen of the module. We are going to discuss from that as well. We're not going to put notes for that. Okay. Okay, one more thing before we jump on to section 139A, PAN requirement. This is a section that I wanted to discuss. It is the, let's say for example, there is business reorganization which is happening. Let's say for example, there's business reorganization which is happening. Let's say amalgamation, demerger, any kind of acquisition. So all of these business reorganization, amalgamation, demerger have to be approved by the NCLT, National Company Law Tribunal. Or if there is insolvency, then under the Insolvency and Bankruptcy Code by the adjudicating authority. So this year onwards, they have said that, if you remember, there was section 170. There was section 170 which provided for the assessment happening in the case of business reorganization. Do you recollect that? Succession of the business, how the assessment will happen. We had done that while we were dealing with the topic of assessment of various entities chapter. How the assessment will happen in case of the succession of the business. Do you recollect that? Yes or no? Yes, students, you recollect what was the provision? Assessment of the entities in the case of the succession of the business. Yes. I had discussed that. If there is change in the constitution of the firm, if there is a succession of the business, yes, I'll show you. First of all, we'll look at that. So if you remember, I had discussed this particular topic, assessment on dissolution, change in constitution or succession of business. If there is change in the constitution change means retirement, admission or change in the profit sharing ratio. then assessment to be made on the reconstituted firm. If there is succession by another firm, then there is a separate assessment on the old and the new firm. In the case of the dissolution, the firm shall be assessed as if not dissolved. So this was in the case of the partnership. Similarly, we have even for the companies. We have even for the companies, or even in the case of any other business entity, which is in case of the succession of the business, where the amalgamation is happening or where there is demerger which is happening. So in that particular case, how the assessment will happen? So when a person is succeeded by another person, then the assessment will happen on the predecessor up to the year in which the succession takes place. So the income of the previous year in which succession takes place up to the date of succession, the assessment will happen on that, and on the successor in respect of the income after the date of succession. So the income needs to be apportioned between the predecessor and the successor with the share of each. So the income has to be separately computed. And in case there is a succession which is happening, then the assessment also will be made on the predecessor if there is any succession which is pending. So any assessment which is pending on the predecessor will now be made on the successor. Are we clear? So the assessment also will happen like that. Yes or no? So you can just write it over here. Just write it over here. In the assessment of various entities only, you can just write down. Succession of business. Section 170. Succession of business, section 170. Income to be apportioned between predecessor and successor. Income to be apportioned between the predecessor and the successor. For the predecessor, from 1st April to date of succession, and for the successor from date of succession to the 31st of March. Are we getting that? So the income has to be apportioned between the two. And any proceedings which are pending on the predecessor during the course of the pendency, the assessment will now be made on the successor. Are we clear? Yes or no? So this is something which we had already discussed in the assessment procedure class. Okay? Now, understand one thing. If any capital gain also arises by virtue of succession, then the successor is required to pay tax on that capital gain, which is accruing to the predecessor. Tax on capital gain accruing to predecessor, or you can write tax on capital gain on succession. accruing to the predecessor to be paid by successor. Okay. Now, what this particular new return filing for the modified return requires? Let's try and understand. So now, this year onwards, they have said that if the succession is happening, or in case of a business reorganization, where prior to the date of the order of High Court or Tribunal, any return of income has already been furnished by the predecessor, right? Then the successor entity will furnish a modified return within 6 months from the end of the month in which the court order is issued. Okay, so then the assessment will happen on the basis of the modified return. If the proceedings are already completed on the successor, then AO has to pass a modified order redetermining the income based on the modified return which is furnished. If the proceedings are pending, then the AO has to complete the assessment taking into account the modified return furnished. Are we clear? So let's say, for example, if A merges with B with the order of the High Court, which is issued on, let's say, November 23. And B has already filed the return of income. Then B has to file a modified return within 6 months from the date of the order of High Court. So order of High Court is of November, then 6 months from that, which comes to May. By May 24, it has to file the modified return. So just write down over here. Modified return to be furnished within 6 months from date of issue of order. AO to complete or revise the assessment completed. AO to complete the assessment or revise the assessment completed, taking into account modified return. Yes, students, clear? Mansha, if SSC has selected wrong ITR, though he has disclosed all the income, but it is possible that he has not disclosed all the information. Let's say, for example, you wanted to go for ITR 2, but you have wrongly selected ITR 1. Now, in ITR 1, you cannot disclose the directorships, the shareholdership in different company, where you are shareholder, where you are director, the details of the foreign assets. So it will be counted as tax evasion. So you should file a revised return. Clear? Yes, Namrata, as I said, that if you file the wrong ITR, then please consider revising the return. Okay, students? Yes? Okay. So now we move to the topic of PAN. So, person mandatory required to obtain PAN. So 139A talks about for the requirement of obtaining the permanent account number. Now, who is required to apply for the PAN? Every person whose total income exceeds the basic exemption limit. So every person whose income exceeds the basic exemption limit is required to apply for the PAN. The time limit for making the application is on or before 31st May of the assessment year. Every person carrying on the business whose turnover or gross receipts are likely to exceed rupees 5 lakh rupees, then before the end of the financial year, he needs to obtain the PAN. or every person who is required to furnish the return of income under 139(4)(a), which is the charitable trust. So the charitable trust is required to obtain the PAN mandatorily. Are we clear? Then every person who is a resident who enters into a financial transaction, of more than rupees 2,50,000 in a financial year, then in that particular case, he is required to obtain the PAN on or before the 31st May of the immediately following the financial year in which the financial transaction has taken place. Are we clear? So in that case also you require to obtain PAN, or every person who is MD, director, partner or trustee, author, founder or chief executive officer of the above person, even they are required to obtain the PAN on or before the 31st day of the on or before the 31st May of the financial year. Okay. So these are the people who are required to obtain PAN. But these days, if you see, if you want to open a bank account or you want to do any kind of purchase, you need to, or if you want to, invest in the stock market, you're required to obtain the PAN. So these days, obtaining the PAN number is very, very important. As soon as you become 18, more or less, you start obtaining the PAN. Okay. So PAN requirement has more or less become the minimum requirement which is there. Okay. Yes or no, students? Fine. Okay. Then if you look at it, it says there is rule 115BA, which says you have to quote the PAN. Also, there is, rule 114BA is saying that every person who intends to deposit the cash in one or more account exceeding rupees 20 lakhs during the year, then before the date of deposit, 7 days from the date of deposit of cash, he needs to obtain PAN. Or every person who intends to withdraw more than rupees 20 lakhs. So if you want to deposit more than 20 lakh in cash or withdraw more than 20 lakhs in cash, before 7 days of deposit or withdrawal, you need to obtain the PAN. Or any person who intends to open a current account, cash credit account with any bank, he also needs to obtain the PAN. Okay. Then, if you look at it, quoting of PAN is mandatory for the transactions prescribed. So, there are certain prescribed transactions which are requiring that you quote your PAN. So, what are those transactions? Let's see. Sale or purchase of motor vehicles, opening of the bank account. Opening of the bank account requires you to quote the PAN, meaning indirectly you're required to obtain the PAN only, right? Then making an application to any bank, again for the issue of the credit or debit card, you're required to quote your PAN. Opening up of a demat account, you're required to quote the PAN. Payment of rupees more than 50,000 in cash to a hotel or restaurant. If you pay in cash more than rupees 50,000 to any hotel or restaurant, you need to quote your PAN. Payment for the travel to the foreign country or purchase of the foreign currency in cash of rupees more than 50,000, you need to quote your PAN. Payment to a mutual fund for purchase of units exceeding rupees 50,000. This is not in cash. Payment for purchase of debentures or bonds. Payment to the RBI for purchase of bonds. All these amounts, mutual fund, debentures or the RBI bonds exceeding rupees 50,000. Deposits with the banking company where cash deposit exceeds rupees 50,000 during any one day. Or purchase of bank drafts where the cash amount of more than 50,000 is used. A time deposit, fixed deposits, recurring deposits where the amount is more than 50,000 or rupees 5 lakh during the financial year. If one time 50,000 or during the financial year, more than rupees 5 lakh. Purchase of prepaid instruments more than 50,000. Purchase of LIC more than 50,000. Contract of sale purchase of securities more than 1 lakh. Sale or purchase in the stock market of more than rupees 1 lakh. Sale purchase of immovable property exceeding rupees 10 lakh where the stamp duty value exceeds 10 lakh. Or sale or purchase of any goods exceeding rupees 2 lakh, you are required to obtain the PAN. You are required to quote the PAN in these transactions. Now, this is not applicable to non-residents. Non-residents are not required to obtain PAN in respect of the transactions which are, let's say, the sale purchase of immobile property. Even if it exceeds rupees 10 lakh, non-residents are not required to obtain the PAN for that. Or for that matter, the sale purchase of the stock market, sale purchase of the shares listed on the stock market, sale purchase of any other shares, even if it exceeds these amounts, then also these non-residents are not required to obtain PAN. Or for that matter, you have the LIC premium being paid by a non-resident, or the fixed deposits purchased by the or deposited by the non-resident. In that case, the non-resident is not required to obtain PAN. Or for that matter, even in the case where you have the saving bank account deposit or the purchase of the debentures, or for that matter, in the case where the non-resident is not required to obtain the PAN, is not required to quote the PAN in case of the transactions which are listed here in terms of the sale or purchase of motor vehicle, opening up of saving bank account, opening up of demat account, or purchase of mutual funds. For them, the non-resident is not required to obtain PAN. Are we clear? Yes or no? But if there is sale or purchase of any goods to a non-resident exceeding rupees 2 lakh in cash, then not cash, exceeding rupees 2 lakh, then even in the case of non-resident, the PAN is required to be quoted, meaning the non-resident is required to obtain the PAN. Clear? So this is for the requirement of obtaining PAN. Now, in case, let's say, for example, you have the TDS TCS statements, you have the TDS TCS certificates which are given. There also the PAN needs to be quoted. In case you do not have PAN, you can also provide the Aadhar number as well. You can provide the Aadhar number as well. Also, in case where the person whose responsibility lies, the person who is, let's say, for example, in the case of cash deposits, it's the bank's responsibility to ensure that the PAN number quoted is correct and authenticated. Right? In case of opening up a bank account, again, it's the bank's responsibility to verify that this is right. Now, who is not required to obtain PAN? As I said, a non-resident who is a foreign company who has made the investment in the InvITs, in the AIS, foreign company which has the capital gain on the sale of GDRs which are listed in IFSC. In those cases, the PAN is not required to be obtained by the non-resident if they furnish their name, email, contact number, address, declaration that they are resident of the other country. So in that case, they are not required to furnish the PAN. They are not required to even obtain the PAN. Forget furnishing, they are not required to obtain the PAN. Yes or no, student? Any questions and doubts? So they are even exempted from filing the return of income. They are also exempted from obtaining the PAN. And in case you fail to comply with the provisions of 139A, if you do not obtain PAN, even though you're required to, there's a penalty of rupees 10,000. Or if you fail to quote the PAN in any document, then 10,000 for each such default. Okay. Or if you are there's a failure to quote the PAN or authenticate that number, again, there is penalty for 10,000. Or you're quoting a wrong PAN number, again, the penalty is 10,000. And even on the person who is receiving the PAN number from you, he has to ensure that the PAN is correct. If he doesn't do that, then again, there is a 10,000 default, 10,000 rupees for such default is the penalty. Are we clear? Yes or no? Any doubts, any questions, student? Yes. Yes, students, any doubt? Any questions? Is that clear? This is very simple. Okay. Let's proceed further. Then we have quoting of Aadhar number. So every person who is eligible to obtain Aadhar number is required to mandatorily quote Aadhar number. Now you are also required to link your PAN with Aadhar. If you do not do that, then in that particular case, it will be considered that the PAN has become inoperative. So if you do not link your PAN to Aadhar, the due date was 31st March 22. Now you can only link it after the payment of rupees 1,000 as the fee. So there's a late fee which is applicable. Now, if you again do not do that, then in that case, the refund will not be issued to you. The interest will not be paid on the refund due. The TDS will be deducted at the highest rate. It will be deemed that if you do not link your Aadhar with the PAN, it will be deemed that your PAN has become inoperative. And if your PAN has become inoperative, then your TDS is or the TCS is deducted or collected at the highest rate. The refund will not be given to you. So in these cases, you have to ensure that the PAN is linked to Aadhar by paying a late filing fee of rupees 1000. Clear? Yes or no? And this Aadhar requirements do not apply in case of the residents of Assam, Jammu, Kashmir, Meghalaya. A non-resident is not required to obtain Aadhar. A person more than 80 years of age is not required to obtain the Aadhar, or a person who is not a citizen of India is not required to obtain the Aadhar card. Yes, students, any questions? Fine. These are very, very simple topics. That's why I'm not spending too much time on them. Okay, these are self-explanatory as well. Then who is required to verify the return? In case of individual, the individual himself is required to verify the return. Now you have the option of e-verification. You do the e-verification. You then, what do? Through the OTP, through the Aadhar OTP, then you have the through net banking, you have option to sign. So who is required to e-verify? The individual himself. Where he is absent, he can give the power of attorney to any other person. Where he is mentally incapacitated, then his guardian. Where it is not possible for him to verify the return, then he can give the power of attorney. In case of HUF, the Karta, or if he is not available, then any other adult member of the HUF. In case of company, it is the managing director. And if the managing director is unavailable, then any other director for this purpose is required. Where the company is a non-resident, then in that case, again, the managing director who holds a valid power of attorney. Then where the company is being wound up, in that case, the liquidator. Where the management of the company has been taken over by the government, then the principal officer. In case of insolvency, the insolvency professional. In case of firm, the managing partner. In case there is no managing partner available, then the any other partner of the firm. For LLP, it is a designated partner, right? For the local authority, the principal officer. For political party, chief executive officer. So these are the person who can verify the return of income. Now, before we close the session, there is one more topic which is not listed over here. Okay. Which is in the case of the e-campaign notices that you are receiving, that I wanted to talk about. How you are receiving these e-campaign notices. How is it that you're getting these kind of notices for the e-campaign? How the government gets this information? So let's talk about it for last 5 minutes. So basically, there is something called as Statement of Financial Transaction. SFT, Statement of Financial Transaction, which is required to be furnished by certain person. Now, what are these Statement of Financial Transaction? As the name suggests, it represents certain financial transactions. Now, what are these financial transactions? Let's try and understand. So, Section 285BA of the Income Tax Act. Section 285BA of the Income Tax Act mandates certain person to file these statement of transaction. It is obligation to furnish the statement of financial transaction. And these persons who are required to file are given in the Rule 114E. In Rule 114E. So who is required to furnish this statement of financial transaction? If there is payment made in cash amounting to more than 10 lakh in a financial year, or there are cash deposits or cash withdrawals more than rupees 50 lakh in the financial year. If somebody has paid rupees more than 10 lakh in my account in cash for purchase of bank, not my account. If somebody has paid in cash for purchase of bank draft or pay orders or banker's check for more than rupees 10 lakh, or there are cash deposits in my account or cash withdrawals more than rupees 50 lakh. then the bank is required to report this transaction through the SFT, through the Statement of Financial Transaction file. Or if there are cash deposits made more than rupees 10 lakh in my account other than the current account, then also the bank is required to report this. Or if the time deposits are more than rupees 10 lakh, if there are one or more time deposits made, the fixed deposits are made more than rupees 10 lakh during the year. Or if, let's say, for example, I have made the payment of more than rupees 1 lakh in cash or more than rupees 10 lakh through the banking mode against the credit card bills, then the credit card companies, the banks, which are the banks, cooperative bank, they have to report it. Or let's say more than rupees 10 lakhs are received for purchase of bonds or debentures, then the company issuing the bonds or debenture is required to report this transaction. Or if, let's say, for example, there are receipt of more than rupees 10 lakh for acquiring shares, then a company issuing the shares has to report this transaction. If buyback of shares is happening more than 10 lakh, then a company buying back the shares have to report this transaction. Mutual fund company, where I am purchasing more than 10 lakhs mutual fund, then the mutual fund company needs to report it. Where I am purchasing the foreign exchange or incurring foreign expense more than rupees 10 lakh, then the authorized dealer needs to report it. Immovable property more than 30 lakh, then the registrar needs to report this transaction. Purchase or sale of goods in cash more than rupees 2 lakh, then the person who is required to do the tax audit needs to report this transaction. So where I am receiving more than rupees 2 lakh for sale made by me, I need to report this transaction. So basically, once this transaction gets reported, the income tax authorities will get to know that these are the high value financial transactions being conducted by the assessee. So these are the high value financial transactions which are required to be reported by the banks, by the mutual fund company, by the company issuing the shares, by the company buying back the shares, by the company who is making the sales and collecting the amount in cash. They have to report these high value transactions. Now, income tax, once it collects its information, matches with the records of the taxpayer, whether they have filed the return or whether they have not filed the return. If they have not filed the return, whether they have disclosed this particular income or not. And that was the e-campaign notice. So the information that the income tax department collected now gets reflected in your annual information statement, which is AIS. You see, purchase of FDs, purchase of shares, redemption of FDs, right? You see that in your AIS. So the income tax department issued these notices for all the taxpayers, whether they had filed the return or whether they had not filed the return, to just ask them to verify that have you included this information in your return. If you have, then just reply to us as a feedback to AIS that yes, we have reported. If you have not reported, then also report to us that whether this is income, whether you have missed it out. So just consider revising your return or consider filing the updated return. In case you think that this is not the income, give it a feedback to the AIS. In case you think that this should have been considered, just file your revised return or file your updated return or file a belated return if you have not filed the return prior. This was the e-campaign which was going on. So all these emails were issued to the taxpayers whosoever had conducted the high value transaction, whether they had made any remittance outside India, whether they had purchased fixed deposits, where they had purchased the immovable property, where they had undertaken the purchase and sale of the shares, where they had undertaken the purchase or sale of the mutual funds. So all of these taxpayers had received these e-campaign notices. Are we clear? So this happens because the information gets passed on through these banks, through these companies to the income tax department by way of the SFT. Clear? Yes, students? Yes or no? Fine. So we are done with the return filing requirements and updated return also we have completed it. So in the next class, we would be starting off with the assessment procedures properly in terms of the notice that are issued. Updated return is effective from the last year Mancha. Yes, any other questions, students, before we close the session? Namrata, you have an option to go on the compliance portal. You have to go on the compliance portal through the login of the taxpayer on the income tax website. You go and log in, and there you will have option to go to the compliance portal. In the compliance portal, you will have the option to see this information that you have received. There you can just put a reply, or you can also submit. Alternatively, if you are not able to see that, you can just go to the income tax compliance portal, and in the AIS, you have an option to give the feedback. Thank you so much, students. Okay. Okay, so we'll close the session for today. See you in the next class. Please revise the updated return at least. And in case you have not revised the charitable trust and the VDAs, the equalization levy, please revise that as well. Mohammed, goods purchased with cash more than specified limit, does the tax auditor has to report? No. The assessee has to report. The company which has received the amount has to report in the SFT, not the tax auditor. Clear, Mohammed? Okay, so thank you so much. We'll close the session over here. Yes.